Hello, everyone. Welcome to my lecture on economics and finance. I'm Gelo Largo, a member of CAP for PIDC, and this is more or less the fundamentals of economics and finance and how you can apply them in debating, specifically in the context of debate motions and how we normally engage with the kinds of topics that normally occur in the range of stuff that we discuss in debate. So, I guess before going into the actual nitty gritty of the lecture, just some stuff on caveats first. So, one, this is a lot of it condensed from my theoretical experience with studying economics and learning economics as a student. So, a lot of this is stuff that's come directly from my undergraduate major, which was in economics. I specialized in financial economics. Um, I covered a lot of specific economic theory and stuff that was directly applicable towards debate in my education, which is also the reason why there's a lot of stuff that I think are important to prioritize and important to correct as well. Things that will help in nuancing debates about economics that I've applied here. The second caveat here is that there's also a mix that I've had to make with regards to what is important to know and what is not important to know. And that's based on my debate experience and what I've come to learn from debating these kinds of motions and what typically ends up being the more high value stuff that ends up being important. So I could, for example, talk about uh, the CAPM formula, or I could talk about beta as a measure of market volatility, but I wouldn't want to do that because that's something that is a little too granular and not applicable. Whereas I think a lot of the stuff that I'll talk about later are stuff that I think are nuanced but grounded enough that they can be used to debate directly. The last thing here is that it's somewhat subjective as well. So, given that I have a limited amount of information that I can convey within an hour or so, and this is likely gonna last for that amount of time only, and I don't really have the fullest amount of time to discuss all of the possible, I guess, like grounding for a lot of the theory and um, a lot of the deeper concepts here. I think it's important to discuss the more, I guess, what I view to be important and what I view can be covered within this lecture. A more advanced lecture, for example, in the more nitty gritty aspects of finance and like corporate regulation might be necessary, but I think I cover it enough within the lecture that it is still sufficient to help someone with um, approaching intermediate level debate experience or upper level debate experience. And even if you're not a person that has majored or specialized in learning about these things, I think it can be helpful. So with that out of the way, first thing to discuss: scarcity and trade-offs. The most important thing to know about economics is that economics as a concept exists because we as a society and in our world have resources, land, labor, and capital. All of these things that we want, they are limited. But the wants of humans are unlimited, right? Every single person wants more. They want more food, more travel, more good housing, more good services, faster internet. Everyone wants something else. And the gap between the reality that we have limited land, labor, and capital, and that we have unlimited wants, is something we call scarcity. Scarcity requires something to be given up. Every choice we make has something we give up. It's called the opportunity cost, the value of the next best alternative that we give up in pursuit of a particular choice, right? It's not just what you spend, it's the value of the next best alternative you could have had done instead. So every economics debate can be boiled down to an understanding of scarcity and trade offs. And everything can be discussed in terms of what is to be prioritized. For example, what societies should produce, how should they produce them, and for who they should produce them for. And ultimately, there is always some degree of trade-offs and some degree of opportunity costs that exist as well. This is relevant especially for things like governments, right? Where governments typically aggregate resources among people from stuff like taxation. And they face significant trade offs in how they justify or what they want to spend that money from taxation on. They could spend it on healthcare and have healthcare be paid for that. uh, or for example defense, which they could boost for the protection of the society, or for debt reduction, right? All of these things exist as things that the government cares about, and in an ideal world governments would do all of these things, but they often cannot because of limited amounts of money and limited amounts of ability to tax. And so there is a trade-off that they face all the time. So debates, in general, economic debates, are about scarcity, the opportunity costs that we face, and what trade-off we're willing to take is better for society. So that's why typically, whenever there's an economics debates or economic debate, uh, people tend to, I guess, harp on what trade-off are you willing to take? What trade-off are you actually taking? Right? People tend to prioritize that as an aspect of it, right? Rather than just saying that, hey, we win on everything. We want to get everything. Next, on supply and demand. So most people intuitively understand supply and demand. Demand. People buy more when prices are low, less when prices are high. Makes sense. Supply. People produce and sell more when prices are high, and produce and sell less when prices are low, right? You want to do the opposite because you're the person that stands to gain when the prices are high and stand to lose when the prices are low. This is tend to be portrayed through the supply curve and the demand curve, and those typically are opposite, right? They all work in the opposite way. Um, this is important because there is no society or there's no outcome economically that is perfectly likely to create good outcomes for demand and good outcomes for supply. In a market, typically, when there is a, let's say, a price cap that is enforced on, let's say, all toys during Christmas, right? If that's the case, sure, consumers benefit significantly from it, but that means that the amount of suppliers that would benefit and the amount of suppliers that would continue supplying to the same extent would be less because they just cannot profit off of the significant amount of people that want to buy toys during Christmas in the same way that they were able to do before. That's what creates these kinds of um, examples, right? Like shortages and surpluses. Shortages obviously is a shortage or a scarcity of the produced amount of thing that people want. So when people want a certain amount of thing X, it's less than X, and then surpluses is basically when there's too much, so more than the amount that people actually want. Typically, these things happen with ideal economic theory. They happen when prices are not allowed to adjust freely. So, as what I said earlier, a price cap, its rent controls on apartments, for example, typically means that there's a limited number of people that want to create new residential housing. Minimum wages, you could even argue, is an example of prices not being allowed to adjust freely, which can, and some people do make the argument, although it is to varying degrees persuasive and unpersuasive, causing and contributing towards labor demand and problems in societies. Typically block these kinds of signals from happening the way that they're intended to. Inflation. So again, just to say it, there is some degree of like, it's not the perfect segue of topics, but I think you'll see at some point why I'm organizing the concepts in this way, around the end point. Why it came in this order. Inflation. So what is inflation? So now that we know about price signals and now that you know about supply and demand, inflation is just a sustained rise in the general price level of goods in that society. Specifically, this is tied to a basket of goods usually. So a basket of goods meaning a set of goods that people care about, right? You can benchmark inflation with rice, the price of rice, which usually happens in the Philippines. You can benchmark it with the cost of coffee. Maybe last year it cost $2 to buy coffee. Now it costs 10. And there's a certain amount of inflation that's generally sometimes accepted by people, and the tolerance for different economies and different societies for what inflation is tolerated by people is different. So this is something that varies from economy to economy and the state of the economy as well. How does inflation normally happen? So imagine that the government puts more money into the economy, say through things like stimulus checks, which are very prevalent during the COVID-19 pandemic, or by lowering interest rates, right? So making people more able to borrow because you have to pay less on interest, or by quantitative easing, right? Suddenly, people have more money in their pockets. When they have more money in their pockets, they want to do what everyone wants when they have infinite wants, and they want to buy more things. Want new cars, new phones, new furniture. The demand for these things goes up. When people see, or companies see, that the demand goes up, they need more people in order to meet that demand. Companies typically then need to produce more to meet that demand, and so they need to hire more workers to meet that demand. So they put out more job ads, they compete more for workers. Workers are more in demand. And because workers are more in demand, they are more able to, given that demand, have higher leverage to ask for higher wages. And if it's the case that they ask for higher wages, and because they're in demand, different companies want to produce when there's a surplus of people that want to buy certain goods, that means that companies need to be able to absorb that cost of workers asking for higher wages, and typically that results in companies raising prices. And whether or not that's true or not, as a justification for raising prices for companies, uh, economic theory suggests that that is something that's directly passed on towards the prices for consumer goods, and that typically means that it means the overall amount of goods in the economy is more expensive. So typically people, as an observation, generally get uh, the understanding of inflation wrong. So they typically understand it as, if there's a lot of money that's in the economy, each amount of the money that's in the economy is worth less. That is partially true, but I think the more intuitive and more, I guess, nuanced explanation is that there is a process that happens that usually results in firms raising prices because now there is just more demand for goods, and this typically creates more and more uh, higher prices over time. So that's the more nuanced way of understanding it, right? Mild inflation around 2%, let's say, especially this is in the case of the US, is normal and healthy. This is because it is something you could expect with rising growth in the economy, right? Salaries also rise as well because workers ask for higher wages, which means economic activity supports itself, right? Whether they buy the more expensive goods because of higher wages. Yet, inflation isn't always good. Mild inflation is good. Hyperinflation, where it's very fast inflation, where the prices of goods rise so fast that money loses value very quickly, that's something that's very dangerous. The reason why it's very dangerous is that when money loses value very quickly, people don't want to save anymore, or often cannot save, right? They know that it's losing value very, very quickly, which means that they rush to spend their money very quickly right now. When they rush to spend their money quickly right now, this creates shortages, right? Where everyone is buying everything immediately, etc. And it means that firms often don't have the ability to adjust to that, which means that a lot of times people run out of services and goods that they need. It also destroys financial security for households and families because the amount of money that they're currently parking into things like investment accounts or in their pension, etc., are just worth less. And all of this basically destroys the financial security of that society. And typically, the value of goods becomes so high that it's just very unlikely that you trust in that economy, right? Because the value of the goods are so very different. And so typically at some point people will just stop spending as much as the hyperinflation would initially suggest, and it causes a very very bad point in the economy. um this is an example that we saw in Germany in the 1920s with the Weimar Republic, Zimbabwe in the 2000s. Those are the horror stories, but it's not a very common thing that has happened. It typically happens with very specific instances where there's a lot of hysteria and panic. So, claiming hyperinflation in all of these instances is, I think, a bit quick, but I think it's justified to say that hyperinflation is an important thing. Inflation is also something that can be caused by rising costs just normally as well, from external stuff that are external from the economy, right? Like, for example, the rising cost of oil, it causes inflation in the Philippines. Or wages, for example, for foreign domestic workers can typically cause uh, foreign Philippine workers can cause higher prices, right? For goods, for example. So this typically is called cost push inflation, right? Where there is just more of a push that comes from the cost itself rather than the was I mentioned earlier, the mechanism that exists domestically within the labor market. Deflation. So what is deflation? Deflation is the opposite of inflation. It's a sustained fall in prices over time. This sounds good, right? In theory, who doesn't love cheaper things? But deflation is actually worse than inflation. And typically it's called the silent killer. Uh, and the reason why is that it typically is very hard to stop. How does deflation actually happen? Because I think a lot of times people say and claim deflation occurs in a specific instance, but it typically doesn't occur to that fullest extent, or they misunderstand where the mechanism actually occurs from. So deflation normally starts with a loss of confidence in the economy. Maybe the big bank fails, like Silicon Valley Bank, or the 2008 banking crisis, for example, or there's a stock market crash or a recession begins because of external factors, like for example the rising cost of oil, or war or external conflict. People get scared to spend. When people are scared, they stop spending and they start saving their money. So they park it uh, into their bank account or under their mattress, right? When a lot of people do this, that means that demand drastically falls. Companies find that they cannot sell the goods that they currently have already made, or they cannot massively just adjust to cut down the amount of goods that they are currently want to make, i.e., because they have existing vertical structures already, which create certain goods, or they just cannot do so because doing so would mean that they'd have to lay off workers, right? So companies find that they cannot just maximally fluctuate towards the amount of goods that are actually being demanded. And so what they do is that because they have warehouses full of unsold products and they want to sell it, they peg their products at lower prices to attract buyers. At this point, it seems okay. Prices are falling, and that's good. But people expect that if it's the case, prices fell in this instant. Why should I buy it today? Right? If I wait a month, a TV that I'm really looking at and eyeing for like a while now might be 25% cheaper or 30% cheaper. If I wait 2 months, it might be more than that, right? So you want to wait, and people wait, and they wait and wait and wait very much longer, right? And demand falls even more. Companies typically, because of the pressure that they cannot really, again, just fluctuate the amount of goods that they're creating, lower their prices even more and even more. And this creates a deflationary spiral. This is what we call a deflationary spiral. So it's not just that prices lower, but that there is a cyclical, in some way pathological cycle that occurs that creates a lowering and lowering of prices offered by companies. Why is this bad? Like, why is it ultimately economically bad? If companies cannot sell their goods, right? They cannot sell their goods. They cannot sell enough goods to cover their costs. They often, because of that, go into debt to pay for the certain kind of crisis right now. When they go into debt, they have huge debt servicing costs, which means that the overall amount of money that they owe and the costs that they accrue are higher. And at some point, even if they go into debt to stem themselves in the short term, they end up overall firing workers in the long term, the longer time the deflationary spiral continues. Unemployed people then, from the amount of people that are unemployed from this particular deflationary spiral, spend even less. And this is a huger population of the economy the longer this goes on. This deepens the spiral even more because now more and more people typically spend less overall and have less consumer demand in the economy. This is bad, and the reason why deflation is seen as a worse thing than inflation is that it typically is just very hard to stop, right? When central banks see that there are normal recessions, typically what they do is lower interest rates, right? Which means that more people borrow and increase confidence in the economy. But when the rates that people are borrowing at is already near zero already, people really want to save no matter what you do. And people aren't just expecting prices to fall regardless. And so they don't want to spend, they just want to save. They won't borrow regardless, they won't spend. They will just hoard their cash. That's something we call a liquidity trap, as I explained later, right? Central banks, generally speaking, have ways to deal with mild inflation or even high degrees of inflation, but they often have very little they can actually do in an instance of deflation. And that's why deflation is often very scary. Recessions. Recession, period of declining economic activity across an entire economy. It's the opposite of growth. People buy less, companies sell less, they stop hiring, some companies start firing people, GDP falls for two consecutive quarters is generally the standard definition of what um, a recession is. What normally causes a recession? One normal cause is a financial crisis. It's when an asset bubble, specifically of a certain asset that people are in high demand for, but typically the value of it is understood to be different than the actual value that is provided by that occurs. An example of this is the housing market, let's say in 2008, or the crash of the stock market, for example, that existed before. It also looks like, um, you know, adverse supply shocks as well. So adverse supply shocks are when a key good suddenly becomes very scarce or very expensive. Think of oil right now with the Iran war. A key good vanishes for people. Another one is a natural disaster, right? Like a massive earthquake, hurricane, or flood. And the last one, and often the most common element in all recessions, is really a loss of confidence. People hear a bad news, they get scared, and they stop spending. The reason that's bad, again, as a mechanism, is it typically ends up being cyclical and often self fulfilling, right? It really just makes the economy much, much worse, and it's very, very hard to stop. Recessions are bad because, as I said earlier, it causes deflationary spirals. It causes bank runs, which means that depositors panic and pull out their money from banks, which means that banks have less money to lend out for people, mass unemployment, lost savings, prolonged poverty. High unemployment is typically linked to worse health outcomes and even increased mortality. And recessions, even if they're seen to be normally part of the wax and waning experience of the economy, the human cost will always exist. It is always better to not be in a recession, even if at some point it will cause a better outcome for the economy, right? Where there's more market adjustment. Typically it means a lot of people lose their income for a very long period of time. And that's something that often means that they lose their homes, their health insurance, their education, their livelihoods. What are bank runs? So, to understand bank runs and how bank runs work, as I said the term earlier, bank runs, you need to understand fractional reserve banking. When banks get deposits from people, they do not keep all of your money in a vault. If you deposit, say, $1,000, the bank keeps 100 in reserve. Only a fraction of them, typically around 8 to 10% in reserve. The rest they lend out. The reason why they lend out is both for their self interest and that they gain money from it, right? When they lend it out to people that tend to want to get loans, they can charge a rate on that and then the bank earns from that rate, right? It's also for the benefit of the economy in a sense because now more people get loans, more people can do productive things like start businesses, fund their education, fund their livelihoods, fund their services, and all of that. And all that's all very good economic growth for society. If many depositors, however, given that again the fraction that's actually reserved is small compared to the fraction that's lent out, if many depositors try to withdraw at the same time, that's when the bank doesn't have enough cash. It fails. Deposits, when they happen all at the same time, means that the bank just has to say, we don't have enough money for you. When, even in a small instance that this occurs, it typically creates a loss of confidence. People hear rumors, even if before it happens, it might happen. And because that they hear these rumors, they want to be the people that get their money out before the bank says, hey, we don't have enough money for you, right? Or maybe the bank collapses and you will just lose your money in general there. You fear that might happen, which is why you want to be the person that gets your money out quick. That's the reason why bank runs typically, as also deflationary spirals earlier, are often self-fulfilling. Even when people feel as if bank runs could occur, that's usually when they occur, right? When, for example, a lot of people end up being wanting to be the ones that get away earliest, right? This can be stemmed by deposit insurance, where governments guarantee some degree of deposits, right? In the United States, it's 250,000 per depositor per bank, right? The PDIC, if I'm not mistaken, in the Philippines is the equivalent. I'm not sure what the amount is. It prevents runs, but often creates moral hazard, right? When banks know that the government can guarantee some degree of their deposits per bank, and if the bank becomes insolvent or fails, the banks will be more willing to take risks and reserve less of their money and lend out more of their money or engage more in more, I guess, risky lending. Central banks, this is usually in the case where what I'm talking about for bank runs, this happens for regular commercial banks, the banks that lend out to people. Central banks are basically the banks that, control the monetary supply of the entire economy. They're the people that act as lenders of last resort. When banks are in trouble and they have no money in reserve, they need to be important. They stay alive because they're systemically important. Uh, like for example, the Lehman Brothers, Goldman Sachs, in 2008, they typically lend to these banks to stop a run because if people then can see that they're actually getting their money back if they withdraw their deposit, typically people stop creating rumors and then that stops the bank run and creates more confidence that's imbued into the bank, right? That's actually the reason why the Federal Reserve was able to stem part of the 2008 crisis, because now more and more of the central bank's function became giving to banks and making sure that there isn't a huge loss of confidence and huge tanking of the trust in these major systemically important banks. So now let's talk about the different types of, I guess, policy that we see in debates about economics. Let's first talk about fiscal policy. Fiscal policy is the government's use of spending and taxes to manage and influence the economy. Fiscal meaning it involves the government's budget, right? Revenue from taxes and expenditure on programs. When we want to fight a recession as a government, we increase spending or cut taxes. Both of those cases would increase the amount of money that exists in the economy, in the sense where the government literally puts more money into people's hands with spending through things like stimulus, or they cut taxes and take less money from people's hands, right, during crisis. Both of these things are expansionary policy. When they want to fight inflation, i.e., the value of goods are too high and it's unsustainable, or for example, far, far different from what they want the optimum amount of inflation to be, around 2%, 2 to 4%. They typically cut spending or raise taxes. It's typically called contractionary policy. So there's two types of fiscal policy. This one cools demand, whereas the prior one stimulates demand. Within this discussion of fiscal policy, it's important to discuss the money multiplier effect, right? Typically, when people say government spending, they think that government spending it's roughly equivalent to economic activity or the same as economic activity. But typically, it isn't. Often, government spending is more valuable than economic activity by regular people. How is that the case? Because say that $1 of government spending pays for a teacher's salary. That teacher spends it at a restaurant. The restaurant pays, for example, the chef that created the food for that teacher. The chef spends it at a grocery store. The grocery store pays its cashier, right? Typically, that is a very many amount of times in which that dollar circulates and creates multiple rounds of income for people, where they spend it then also on the economy, creates value for the economy. Compare this to where if you had $1 for people, they can park it in a savings account, and that doesn't create this sort of effect for incomes for people increase overall. That's what people say the money multiplier effect actually is. The risk, however, is something called crowding out, right? When the government borrows money to spend, right? It borrows money uh from people, right? It borrows money. It pushes up demand for loans in general, or borrows money from people or from banks. It pushes up demand for loans in general. When demand for loans are very, very high, that raises the overall value of loans. And banks know that loans are more valuable, which means that they can, using that leverage, increase interest rates. And because they have higher interest rates now for the loans that they offer, it makes it more expensive because, again, the government was borrowing a lot, created high demand for the loans that they were offering. Now that they know that, they can charge higher interest rates, and higher interest rates mean that it's harder for people to do private investment. So businesses find it harder to borrow and harder to invest in things in their average day-to-day lives. That's what's called crowding out, like in the mechanism there. The other aspect is monetary policy. Monetary policy is what's handled by the central bank. So whereas before it was handled by the finance minister of that country or the economic minister of that country, monetary policy is handled by the central bank, which is usually an independent arm from the government. This is important because it's important that they are not politically influenced to set rates at a specific way or to influence money supply in a specific way. That's important for, I guess, trust in the economy. It's important for people to feel that there's a certain stability and it's not going to be waning and waxing from the political shifts that might happen that are unpredictable. That overall means that we can maintain more price stability and more trust. To fight the recession, the central bank lowers interest rates. People borrow more because interest rates are lower. They save less and spend more. Uh, when they want to fight inflation, the prices of goods are very, very high. They raise interest rates. That means that borrowing becomes expensive, spending slows overall. When interest rates are already near zero, so it's very, very inexpensive to borrow, say that's the case, right? And they still want to increase the amount of spending in the economy, encourage people to spend. Let's say, for example, in cases where there's like a crisis or a recession, people want to increase confidence in the economy. Central banks use quantitative easing. What is quantitative easing? Quantitative easing creates new money. A central bank creates new money electronically and uses it to buy government bonds that are held by banks. Often it's also corporate bonds, but usually it tends to be government bonds. When they do so, because they created new money electronically, this injects cash when they buy bonds from banks. They give the money in exchange for those bonds to those banks, and those banks lend out to the economy. This directly injects cash into the economy. And this overall, because there's more cash, there's more ability to loan out for a lot, so there's more loans, lower amount of value for loans, which means that there's lower interest rates. Encourages more lending and boosts the asset prices of the economy overall. So, as I explained earlier, central banks are the lender of last resort. What is the liquidity trap then? A liquidity trap is a special example, as I explained earlier, where interest rates are near zero, but people still refuse to spend or invest in the economy. They feel that the prices of goods could occur to be lesser in the future, i.e., deflation, and then because they expect that it's happening already, a deep recession is happening, people are pessimistic and they think it's going to get much lower and lower over time. They hoard cash, and when they hoard cash, that means that they don't want to spend. In liquidity traps, monetary policy becomes very ineffective. Cutting rates further often doesn't do a lot, right? Or often doesn't do anything because rates cannot go below zero in any meaningful way. If they do become negative, like what happened with Japan in the 1990s, often banks just may pass the cost to depositors, right? The cost of literally negative interest rates. They have to pay people to get more of these borrowings, for example. Typically, it means that they pass the cost to depositors, which is deeply unpopular, right? And deeply unlikely to actually like make people more confident in the economy. So what do you often do? In the example where there's liquidity traps and the interest rates are very, very low already and people are very, very low in trust, often the solution is fiscal stimulus. And that's the reason why it's important to understand the balance between fiscal and monetary policy. Where one fails and where one can fill in that failure is important because both of them have roles that fill in with each other. Where fiscal stimulus is less able to control the actual interest rates in the economy, that's why you need the monetary policy to actually do that. Monetary policy has limitations where interest rates aren't the important thing to consider anymore. It's about confidence, and rates are very, very low. The only thing you can really do is increase government spending to restart demand and increase stimulus in the economy to restore demand. Loss of confidence. As I said already, just to reinforce this as well, many recessions are caused or worsened by a loss of confidence. Often, typically, it's not just a symptom of a crisis, it's often the cause for many, many major crises in the world. Economic crisis often in many different kinds of economies, and it can turn a small problem initially into something that becomes a large-scale disaster and catastrophe for everyone. Because when people get scared, even on a small scale, and then they start saving instead of spending, this creates cascading effects on demand. And when there's cascading effects on demand, companies struggle, creates layoffs, more fear, more struggles, more layoffs, overall cyclical problem of crisis. When governments know that this is happening, i.e., there's a crisis that's occurring, they can act preemptively. If people know a bailout or stimulus is coming, and because the government said they're going to do it, they're less likely to panic and less likely to cause that in the first place to be necessary. That can be helpful as a mechanism for explaining why governments are better off, or even central banks are better off, in communicating what they're willing to do in the instances of crises. Transparency can help as well. If the government announces which banks it will rescue, depositors feel safe and runs are avoided. Transparency in general, like by the media, is also important as well. But withholding news can also prevent panic. If some news say that there is a lot of uh, banks not being able to meet the demands of withdrawals, right? And that means that there's overall more distrust that that bank might even stay alive in the future. There might be more and more people that want to withdraw and force the bank to try to get their money back. And that just means that more and more people end up making the bank's prior smaller crisis a bigger and bigger crisis until it's no longer avoidable. So there is a debate that's valid about whether government should hide damaging information even during a crisis. Because even if it might not be something that's best for everyone, uh, or even a principled good thing in some instances, what you can say is that it actually reduces the overall amount of people that panic and creates crises in the future. Money. What is money? Money has no value in and of itself. We value money because we can buy things with it, right? This segues more into the finance stuff later, where we're dealing more in specifically the exchange of things and how we exchange money in the economy. Money serves three functions. One, as a medium of exchange. When we buy things and sell things, instead of bartering, we use money. We use money to trade, to get goods instead of having bartering, which is far more inefficient in a sense because you have to have the equal need for two goods at the same time, which is often hard to maximize matching in a large scale economy. It also serves as a store of value where you can earn money today and spend it next week and next month or next year. And it holds its purchasing power more or less. Even though there might be inflation that erodes it somewhat, typically it can still hold its purchasing power, whereas you don't know if bartering, the thing you bartered for, would hold that same amount of value. Also, then, it also serves as a unit of account where it can use to measure prices and measure value. Money, 500 pesos is the value of that thing. And you know that that is five times as much as something that's worth 100 pesos. And you know that because pesos are the unit of account where you measure, right? Modern money is fiat currency. So most money today typically exists digitally often. Physical cash is only a small fraction of the actual money supply. The rest exists as bank deposits as well. And typically, when we say fiat currency, these things are not backed by something else. So usually, uh, you would expect that they have some external backing, but typically they don't. Before they used to, a lot of economies had their currencies backed by gold because it means that gold could at least guarantee that that thing had actual value. Nowadays, most economies have currencies that are backed because the government says that they are important and says that they have value. And so, because that the government says that they have value, they get value from people. People opt into them, people exchange stuff for them, and they operate with them. So, that typically means that most money exists again tied to confidence, tied towards how people value that economy and how people see that government and that society. The quantity of money affects inflation. So, if too much money chases too few goods, so what does it mean? If there's a lot of money in the society, if there's too much money that the central bank is creating, but there's not enough of a corresponding increase in goods and services. As I explained earlier, it's not about there's too much money and the value of money is less, but rather because there's not a corresponding increase in goods and services, People again hire more workers, and when they hire more workers, because there's higher demand, workers can demand more for higher wages, and that increases prices, right? So if too much money chases too few existing goods, prices overall later on increase and increase over time, creating more inflation. Stocks. What are stocks then? So, comparison to money, stocks are a share of ownership in a corporation. So, they're not a physical object, the same way that money typically is, or not a something that can be very easily or directly liquid, right? Like liquid in the sense that you can transfer it with someone else, not like money. Shares or stocks is a share of ownership in a corporation. Why do people buy stocks? There are three reasons for why people buy stocks typically. One, it's dividends. People want regular payments from the profits of that company. They typically want, this is typically people who are normally not super risky. They want steady income. This is usually stuff like pension funds, insurance companies, hedge funds, even retired individuals. They like stocks because it means that even if it's not the biggest dividends in the world, i.e., what the company is willing to give out to the people that own its stocks, like extra profit from the company, um, they're willing to stick with that or deal with that because they want to stay with something safe. Another reason is control. So if you own a large number of shares of a company, say 5% or more, you have significant voting power at shareholder meetings. You can influence, for example, who sits on the board of directors. You can influence, for example, uh, who or what is being proposed at the company, right? And that means that you have uh, more ability to overall leverage yourself and change the destiny of that company. And so this is normally a more attractive mechanism for other companies, like big companies investing in other companies. Wealthy individuals typically don't care about dividends, they care more about control and how to run that company and controlling how that company is run or how to get more money out of the company. A third reason that people typically put money into stocks is speculation. So, whereas dividends is you want to get the extra profit or company profit that is given back to stockholders. Speculation is you think and you want the value of the actual thing itself, the cost of the stock itself, the price of it to increase. If you want and you're expecting that the price of the stock will increase over time, it means that you can just directly sell the stock at some point in the future. And that would mean that you can gain a profit, a very big profit. And this is what attracts people like day traders. It attracts people like on trading apps like Robinhood, for example, or other apps, etc., app-based investors. There are a variety of different reasons, and as I state here, there are different reasons that affect different people in different ways. What affects stock prices? Confidence in the general economy affects stock prices. For example, recessions typically affect all companies, if not most companies. Confidence in a specific company, so say a product fails in a product launch, that stock falls because they don't think that that stock represents a company that is actually able to gain a lot of profit in the future. And trading trends, right? If a lot of people typically are very, very, what's called bullish in the economy, they want to, uh, they're trust in the economy. The economy is gonna get better. Economy is gonna give more value for people. If they think that's the case, then they want to buy more of the stocks. And if they buy more stocks, then companies have higher value. And that means that overall, like, more and more people get hired, more and more people, increase prices. As I said earlier, prices go up. And when that happens, that can create inflationary problems. It can also create bubbles. Typically can be good, but can create, I guess, overvaluations. That typically means that the prices for these things go excessively high, or prices for average goods that these companies are producing also gets very, very high. And that can create bubbles and can create crises. So the value of a stock does not equal the value of the company itself. These stocks and the prices of these stocks are driven by expectations. A lot of the time, a lot of stocks are not really the value that they're providing to society, but often the value that they're expected to make maybe in the future, the long term, or whatever risk appetite that a specific composition of investors of that particular company have. Now, let's talk about short selling. What is short selling? Short selling is a strategy on stocks where you bet on a stock price failing or falling. How does this work? You borrow shares from someone, usually another broker or a large investor. You typically are able to borrow, let's say, if you're an institutional investor or a big time trader, right? When you borrow, then, what you do after borrowing is you immediately sell those shares at the current market price. And because you sell those shares at the current market price, you gain the cash from that, you gain the value from that, right? Something more liquid. Later on, because you're again assuming that it's going to go lower, you use that money currently, or you could just save that money and see how you profit from it later on. Later on, however, assuming you're right, it gets lower, you buy the stock again, the equivalent stock that you borrowed, and then return it to the person that you borrowed from. You profited the price drop in the value of the stock, right? What actual money you gained from selling it, and the difference in value that, for example, if you had to buy it back, maybe you have some excess there. That's what short selling fundamentally is. It's you betting that the price will go down in the future. Otherwise, if you borrow the stock and then the price goes up, you're kind of screwed, right? It's risky because if the price rises instead, short sellers can lose huge amounts. In theory, it's an unlimited amount. What does that mean? If the price of a price of a stock can only go to zero, right? Typically, because again, like it can't go negative, right? That doesn't make sense. But prices of stock can infinitely rise. Like they can get higher and higher and higher. Like if you to think before in the 2000s that the Nvidia stock would even be as close to as valuable it is today, you would buy into it, right? But most people didn't expect that. But in theory, it's possible that they can be super, super valued, far bigger than any stocks that we ever could possibly even dream of. And if that happens, you can theoretically lose an unlimited amount of money or an unlimited amount of value and often be stuck with an immense crisis there. And so that's risky. And so it typically is done by people who are willing to absorb the risk or people who are willing to take the risk. A short squeeze happens when a heavily shorted stock suddenly rises very sharply in value. That's the case. Uh, so say example of GameStop, right, where retail investors bought the stock en masse, right? Uh, because a lot of hedge funds were currently shorting GameStop, what that means is that because they were currently shorting GameStop, hedge funds had to rush back to buy back their stock, right, to cut their losses. And so because they're rushing back to cut their losses and buying the stock, that increased the value of the stock. And so the retail investors on Reddit, on Wall Street bets, actually gained a lot of money from that because that means they were able to squeeze out some money from these hedge funds because because they knew that they weren't able to, pay back what they borrowed, they wanted to buy back the stock right now as fast as possible to limit the amount of losses they had. So that's the reason why the incident on GameStop was so prevalent for making people think about short selling and the value of short selling. Even though short selling and market speculation and these kinds of collective action moments in finance are very, very limited examples in actuality. And typically, this is done by large scale institutional investors or the people that profit one way or the other of a short or a movement to short a stock. Typically, are more successful retail investors or institutional investors, anyways. Initial public offering. What is an IPO? An IPO is when a private company sells shares to the public for the first time. So before the IPO, the company is owned by its founders, early investors, and maybe some private equity firms that have invested some amount to gain some stock, gain some equity of the company. Sorry, not stock. After the IPO, however, that means that anyone can buy shares on a stock exchange because they list those shares on a stock exchange. And that means that anyone, average retail investors, pension funds, hedge funds, etc., can own shares of that particular company. What are the advantages of this? This obviously, one, raises large amounts of capital for expansion, for diversification, for research and development, for more and more people being hired, more factories being built. You could say it's very good. Moreover, it can also be that it aligns material interests with profit. For example, you can pay your executives if you now have shares in shares. And that means that the executives, because they're paid in shares, or other people within the company are now paid in shares, they have their own incentives now to make sure that the company is more successful and actually do actual good examples, because it means that, or good actions, because it means that they more directly profit, though they're often paid in shares of the company rather than in just material benefit, which doesn't really require you to have the best kind of job or the best, most accountable mechanisms in your job. Another example is also that minimum shareholding requirements as well within that company. Now the disadvantages. Loss of control. When there's more shares, or there are shares being issued publicly, shareholders now have voting rights, right? And they can do stuff like hostile takeovers. What does a hostile takeover mean? It means that other companies typically, or like groups of investors, can buy enough shares to take over the company against the wishes of the current management of that company, and can take out that management, propose new directors, change the actual foundational philosophy of that company, and typically change the entire direction of that company into the future. Another example for why it's disadvantageous to go public is transparency, right? Public companies must file quarterly reports. They have to detail their balance sheet, their income, their cash flow. Anyone in the public can read these things, whereas the amount of people that were exposed towards financial documents before of the internal processes were significantly more limited, or the amount of information disclosed was significantly more limited because they were private companies. They were owned by people privately, right? Their capital was limited there. And so competitors can read it, journalists can read it, short sellers can read it. Every single bad quarter can cause massive crises and changes in your overall stock value or your overall ability to perform as a company. Scrutiny is important as well. If they know it, they can short it. If they know it and they don't like it, then they can just think that they, you know, create more and more bad media against your company, which creates cyclical problems for your companies, like stock value and your share value, and that overall creates more and more problems. Private companies often stay private to avoid these pressures if they aren't hugely capital strapped. That's why there's a lot of private companies typically nowadays that are still unicorns, that are still big companies, Fortune 500 companies, still Fortune 500 companies, even though they haven't gone public yet. Um, they can still be very, very valuable. That's the reason why a lot of companies have avoided being public, avoided being directly exchanged. Bonds. Um, what are bonds? So a bond is a loan. So if you didn't know that already, bonds are loans. That means that in reality, when you buy a bond, you are lending money to a person. It's basically an IOU. When you lend that money to a person, you pay regular interest on the money that you lent to that person. It's called a coupon, and that they pay back that money that you gave that person. They pay the principal value of that money at a set date, and the set date is called the maturity date of that bond. Different kinds of bonds are different in risk and different in value. Government bonds are considered very safe. This example for this is like treasury bonds, right? Or T-bills. Governments, because of this, they're governments. Literally, they can print often more money, or are guaranteed by a significant amount of the population, or are guaranteed by other governments or their foreign reserves. They typically rarely, if ever, default. And because they are very, very safe bonds, they're paying low interest for them. If it's corporate bonds, however, they pay higher interest but carry higher default risk. They are typically rated by credit agencies differently. Bond prices move opposite to interest rates. So when rates rise, existing bond prices fall, right? Your old bond that only pays 5% currently, say you're 5% in terms of regular interest, that's uh, less valuable to you uh, than something that could pay 6% in the future if there's higher interest rates. So interest rates typically move opposite to bond prices. Investors buy bonds for steady income. Same thing for, I guess, people who prioritize dividends and stocks. They want stable, safe, if not the big, overall accruing income over time, and not for big capital gains or changes in the prices of things. Financial intermediaries. So I'll just like glance over this because it's very simple. Banks, they take deposits, they make loans. Insurance companies, they collect premiums from people that are taking insurance policies from them. They pool risk, they pay claims. Pension funds, they invest into worker savings to provide retirement income. Mutual funds, they pool money from many investors. Something that people tend to say, but they don't really understand, is that they pool money from many investors, not just to buy one thing or a certain amount of things, but often they also diversify as well, given the preference of many different people are largely more met in a diversified portfolio, and they want to buy a bunch of diversified stocks and bonds there. Hedge funds and private equity is important as well. For wealthier institutional investors, um, typically hedge funds and equity are less regulated. They take more risks, charge higher fees. They engage more into more risky stuff like leverage buyouts, for example, in the case of private equity, or hedge funds typically invest into more leveraged instances or strategies where they take out more debt. There's higher risk and therefore higher fees and less regulation, but higher ability for you to gain a large amount of income and profit. Risk and diversification. Risk is the actual chance or the chance that actual returns differ from expected returns, especially in the instance of losing money. It's broadly the uncertainty about future returns that you have. Whereas diversification means spreading money across many different assets. When you hold many assets, the firm specific problems that you have, one company failing a specific product or one company's over reliance on, let's say, one key good, like let's say oil, is less specific in another company which is significantly more diversified or more reliant on renewable energy, right? And so that means that the firm specific problem of one thing you invested in is cancelled out by the other thing that's more profitable in the instance where there is a crisis, but they are now more profitable because they are using the resource that's less in crisis. Some risk, however, cannot be diversified away. It's called market risk. Market risk typically means stuff that affects the entire market, like recessions, wars, interest rate changes from the central bank. They affect everything and often cannot be specific to one company or another. When there's higher risk from some investments, from certain loans that they take, etc., that means that investors demand higher returns when they take higher risk. Especially because if there's already existing market risk and the corporation has their own corporate risk, etc. So a corporation, for example, selling, but wanting to borrow money, like let's say said they want to offer bonds to people, to get more money to expand. Typically, they want to have higher returns for that because they know that there's not only a market risk existing, but also that specific company's corporate risk. And so they want to account for that as well. Corporate decision making. A corporation is not one single actor. Multiple people exist in a corporation. What are they? People tend to conflate these two. The board of directors typically care more about shareholder profit, so they have a fiduciary duty, right? They are elected by shareholders directly. Their primary legal duty is to act in the best interests of the shareholders. And they want to maximize profit, they maximize stock price because that means that the board of directors can get more shareholder profit and can overall benefit because they're sort of symbiotically related there. The board of directors typically hires and fires the CEO of the company. They approve major decisions and set executive pay for the different executives. Next, the chief officers, or typically called the C suite, the CEO, the CFO, CTO, so on and so forth. They care more about the personal profit that they have. They want high salaries, big bonuses, valuable stock options. They also care about not being fired, so job security. They also care about working life balance, like especially because you're at a higher level of income, so they want their life to still be intact, reasonable hours, and many care about their legacy as well. So they typically have huge sways and huge corporations, and so they want to affect a good legacy there. So now going down from that level, the highest level is middle management. As I said earlier, people care about money, working conditions, but also they want to gain corporate advancement. So unlike chief officers or board of directors, where typically they've reached the highest rung already of the company, they typically want to get more uh, be credited for specific innovations, which means that there's more competition at this level, more cutthroat level of competition between different people, and they want to ascend more into the working environment. Normal employees have less of a conception about wanting to ascend more, and they typically care more about their just short-term money that they gain from their salary, and they also care about their working conditions, I guess, in terms of safety, flexibility, the respect that they get, and the overall like respect for their conditions within them. Shareholders own stock of the company. They want high returns, but they can have different kinds of risk appetites. Maybe short term like traders, or long term like pension funds, which want to park money into companies that they trust in a long period of time until the company accrues a lot of value, and they can cash in the future, or gain money from dividends, especially. So consumers often are also the last rung here. So the people that produce, or people that consume what's being produced, they vote with their wallets in essence. So they often influence corporate decision making the most, because their choices are the ones that create actual market niches that companies without them would not exist from, and they want to try and capture ultimately at the end of the day. Lobbying, direct lobbying. Companies represent people, like they represent the people within those companies, and their representatives within those companies, they meet politicians, they provide draft legislation for politicians, and because they provide draft legislation, uh, they typically are demanded more money and more donations, and that typically becomes a symbiotic relationship. And because they directly lobby there, they're able to argue for favorable laws. So big companies typically have this as well. Best for shareholders, basically. The laws that are best for shareholders ultimately. Indirect lobbying is the opposite somewhat of this, but also the more subtle version of this, where companies use their economic importance and they signal into the media, for example, that they threaten to move factories or jobs if they don't get what they want. If there's higher corporate taxes, for example, in California, that are more willing to move to Texas, or some other version of threats towards the local government. And that typically ends up meaning that the local government is pressured by consumers or pressured by the public, and they're more willing to do pro corporate legislation. Large firms have more lobbying power than small businesses or consumers, because they have more money to pay for donations, more money to pay for political representation, more money that is tied towards the local economy, which means that if they have indirect lobbying threats, they're more able to leverage that against local economies. And that typically leads towards regulatory capture, where regulators end up serving the industry that are meant to control, because often these industries are so embedded in these economies, it's very, very hard for them to actually get out of that sort of spiral of authority or control. So it's often very helpful to consider whether a policy can or cannot be subverted by corporate lobbying in general. Competition. So I'll just skip some of it because I think I've translated this somewhat earlier. Competition, lower prices, better quality, more innovation for consumers when there's more and more people competing. When there's more competition, firms cannot charge excessive prices because they lose customers, because there's a huge number of people that are offering often the same thing, but with a far more effective price for people. Cross subsidization. A company makes losses on one product to attract customers, then profits on another. This is one way in which they can eke out over competition, especially large firms. Amazon, for example, can lose money on delivery but profit from retail, which is what they often do, which is why their delivery is very, very cheap. Yet their retail costs often are higher than their competitors, yet they go often a lot of people go to Amazon because they say the delivery is very cheap, it's very, very small. Same thing for Costco. Monopolies. Even without a full monopoly, a firm can dominate effective competition, basically, and making it very hard for actual rivals to enter into a space. Exchange rates. Exchange rate is the price of one currency in terms of another. There's different exchange rates. So I won't go very deep into this because I think I'm approaching the 1 hour mark now. Floating exchange rate is determined by supply and demand. Fixed exchange rate, it's pegged to another currency, and it requires a central bank to buy and sell its own foreign reserves to maintain the peg to defend the value of the currency. Weaker currency helps exports. Example of this is China. They become cheaper for foreigners to buy, which means that foreigners want to buy more, but makes imports more expensive, which is why China currently is having a domestic consumption crisis. Stronger currency helps imports, where the United States, for example, can buy a lot of foreign goods, but it hurts exporters. Like the reason why US steel is very, very declining in value is because it's very expensive, or a lot of US consumer goods typically can only be peddled towards the US economy because a lot of times it's very expensive. International trade. When countries trade internationally, they usually tend to trade in the things that they have a comparative advantage in, so what they're relatively good at or best at. Specialization affects this. Like they often want to make uh, stuff that they're best at, and so that means that because they want to focus on their competitive advantage, they often means that they increase the total amount of output that they're creating to intend to trade it to internationally, and that creates consumption beyond what the country could produce themselves, uh, could produce or consume themselves within their own borders. Free trade lowers prices for consumers and increases efficiency. Free trade typically means less tariffs, so the costs that are incurred by people importing stuff from foreign companies, or for example, less barriers for them, like less customs costs, etc. This increases efficiency, but trade also creates winners and losers. Some industries, for example, might not be able to absorb international trade, which is the reason why there's a lot of debates about protectionism, like tariffs or subsidies, to protect certain kinds of sectors of the society that are seen to be very, very valuable. For example, it's stuff like agriculture in the Philippines, or in other countries, it's like manufacturing or um, uh, downstream processing, for example, even if it could be more expedient or more efficient in another place, they often protect these aspects. As I discussed earlier, financial crises typically similar. So I will just skip this, but generally speaking, there's a process in which financial crises happen. And as explained earlier, more unemployment, demand falls, more businesses fail, recessions deepen, and become a cyclically self fulfilling process. Last then on bailouts and bail-ins, or I think this is the second to the last or the last one. Second to the last one. A bailout is when the government uses taxpayer money to pay a failing company's debts. This prevents immediate collapse but rewards risky behavior, like moral hazard. A bail-in is when creditors agree to cancel some of the debt of that particular large-scale institutional uh, investor or company or large-scale financial institution. They take the losses instead of the taxpayers themselves. Bailouts typically are better for one-off emergencies like natural disasters, whereas bail-ins are better when the crisis was caused by irresponsible spending or investing by certain kinds of large-scale financial institutions. And typically that means that they punish more bad behavior, but they can also cause a lot of more confidence because investors would just lose more money, right? They in general just lose money because it's not being paid back; it's being canceled. Um, different kinds of examples you can say, but I hope the definitions are helpful, given some limitations in time. Lastly, preemptive regulation. So, if there's one thing to take away here about this entire lecture is that a lot of times, as what you'll notice again and again, economics is a study in people's psychology and it's a study in people's ability to cause their own crises. A lot of the time, the reason why there are economic crises and financial crises is loss of confidence. If people have confidence, however, that the government will take action, like bailouts, stimulus, deposit guarantees, they trust that the government currently in power would do all of these things well, they would not become scared in the first place. That's the reason why there's often an incentive for them to work with and have greater trust in financial institutions because it means that there's often more ability for them to be trusted that they would do so, and there's overall less crises that are created in the first place. More preemptive regulation as well, like capital requirements on banks, stress tests, deposit insurance, can create crises before they occur. It's always better to stop a crisis before it occurs because once a crisis occurs, it typically becomes harder and harder to stop because it typically enables more and more of itself to emerge and cyclically get worse over time. That happened with 2008, with the Asian financial crisis, with the Eurozone crisis. All of these things typically emerge from failures in confidence, even if they emerge from some external asset bubble collapsing or external crisis or recession. The crux of a lot of economics debates tends to be confidence. So examine whether a policy builds confidence or undermines it, what the actual source of that confidence is, and whether or not, for example, it's tied uniquely to the mechanism that you might be proposing in the debate. Overall, I think that some of these might be more useful than others, or some of these might be more discussed rather than others. I tended to discuss the more, I think, crucial or fundamental things to understand. But hopefully, this lecture was overall helpful, and I hope you guys can use a lot of the mechanisms here for understanding at least the basic terms and making sure that you're able to use some of these concepts practically in these debates and overall gain a greater uh, value that you can get, greater amount of ability for you to convey your confidence when you're debating these motions. That's all from me. Thank you so much.